Welcome everyone. This is part 3 of the fundamentals of investing. This is a beginner's investing series that's 4 parts total. Now, if you haven't watched part 1 and 2, I recommend you go back and start from the beginning. Start from part 1. I'll have a link in the description of this video. But we're basically going from very broad concepts in part 1, and then we funneled that down to just stocks. And we're looking at just businesses in part 2 with the income statement, cash flow statement, balance sheet, and financial operating metrics and ratios, like the profitability ratios. Part 2 is kind of like a little accounting class, just like a mini one. And then part 3, this part, is going to be focused on valuation, which means once you've identified a company that you want to own, when should you buy it? How much should you buy? How do you know if you're getting a good deal? The whole purpose of valuation is basically knowing whether or not you're getting a good deal on something, or at least the goal of it is to determine what something's worth, what you should be willing to pay for it. Now, the first thing that I'll mention again, and I mentioned this as a preface to all of this, that all of this is my thoughts, and there's more than one way to do things. So valuation has many different paths that all lead to the same endpoint. There's a lot of ways you can value something. And, different investors have different preferences. Some of them like very complex valuations. Some of them like very, very simple valuations. And then some of them like doing some stuff in between. And even within simple and complex, there's lots of optionality of the way to value an asset. So we're going to be discussing my preference for valuation, the type of methods that I use, and basically how I like to buy companies that I think are a good deal. I think I'm getting a lot for my dollar. I think I'm going to have good future expected returns. And I think I'm going to protect the downside. I don't think I'm going to lose a lot of money in the companies that I'm buying at the price I'm paying. So that is kind of the goal, is to go over all the things I look at and kind of how I piece it together to determine that I'm buying something at a decent value, that I have a low downside, and that I'm likely going to make money on this asset over time. Now, again, there's so many ways to look at valuation. But if someone was to ask you this question, for example, we hear the words all the time in investing. We hear these terms. This is overvalued. This is undervalued. This is expensive. This is cheap. What do those words really mean? If someone says this stock is overvalued, what does that actually mean? What would you answer? What does overvalued mean? It's too expensive? Well, what does too expensive mean? That there's something cheaper? Well, by what metric? How much cheaper? What does it mean if something's undervalued and something's overvalued? Let's start off with that. So if we go to the whiteboard here, I give the guideline that on average, the stock market has earned around 9 to 10%. Okay, let's say 9 to 10% is what you can get investing in like the S&P 500. So if you throw your money in the S&P 500, you'll get around a 9 to 10%. Now, you don't get that every year. In fact, the S&P 500 rarely ever returns 9 to 10%. But based on the ups and downs, some years it's 30%, some years it's minus 5%, some years it's 20%, some years it's 5%. It averages 9 to 10%. So this is the average return you get for investing in the S&P 500. My goal anytime I'm buying individual stocks is to outperform this. It's to outperform the benchmark index. Because why would I buy an individual stock if my expected return was to be less than the benchmark? It was to be less than the index. That doesn't make much sense to me. If I could just throw my money in the S&P 500 and earn more than what I'm doing right now, then the effort I'm doing in buying individual stocks doesn't make a lot of sense, right? So the reason that you buy individual stocks, in my case, at least the goal I have, is to outperform the index. Now, as a proxy for the index, I can just assume 9 to 10% returns. That's kind of what I'm aiming for outperforming. In this case, I try to get around 15% annualized returns. I'm not aiming for anything crazy. No meme stock returns of 30 and 50 and 100% per year, right? I don't want to get into that territory because once you go for too high of returns, you take on way too much risk. You get to gambling. I'm not gambling. I want decent returns, very attractive returns. So in this case, if you have an asset that I expect to earn 15% returns, this is undervalued. If I can buy something that will earn me 15% returns, or I can buy something else that earns me 9 to 10% returns, This thing is obviously undervalued because the future expected return, my expected return is much higher. Therefore, if I buy that, I'll have a higher rate of return and I'll have bought something that's undervalued because it's outperforming. So the way that I look at the question of undervalued is if someone says, Joseph, what does undervalued mean? In my opinion, I think that means that it will return 15% or more for the next 5 years. It's an asset that has a higher future expected return. When you map it out and you look at the probabilities and I look at what I expect this thing to compound, it'll compound faster than the market. That is what undervalued means. Your future expected return is higher. Now, I think of it that way instead of undervalued meaning that it's selling at a low PE ratio, right? A lot of people look at ratios and that determines whether or not they believe something's undervalued or overvalued, but that's not definitive. For example, if we look at, let's just bring up a stock here. Let's look at, we can bring up any of them. Let's look at Chipotle. It's a company most people know. A lot of people look at this and say, it's overvalued because it's at a 54 PE. The forward PE is the price to earnings you're paying for the company. So you take the earnings, the total net income of the company, and you look at the multiple you're paying based on the market cap of the company. Or you take the earnings per share and you look at that compared to the share price. It's a price to earnings multiple. So that's what a forward PE is the price to earnings on the next 12 months. The trailing PE is the price to earnings on the trailing 4 quarters. So you're looking at price to earnings multiples there. And some people will just make quick judgments based on the PE ratio. It can be helpful, but the problem with just judging whether or not a stock is undervalued or overvalued based on just the PE ratio is that you don't have any other expectations. PE ratios don't take into account the magnitude a company is reinvesting back into its business. So if a company is reinvesting all of its profits today back into future growth, it'll have an artificially high PE ratio, but it will really be growing internally super fast, which means that the company's intrinsic value is higher than what the PE ratio would imply. So PE ratios are helpful. They're quick guides. You can look at them and kind of get a company's valuation at a glance, but they do not paint a full picture. Amazon looked super expensive from 2006 to 2019 because the PE ratio was really high. In reality, Amazon was super cheap that whole time because Amazon just took all of their profits and reinvested it. So PE ratios leave out that reinvestment. And in that case, it doesn't show you the full expectations of a company. So again, valuation and expected or valuation and undervalued or overvalued to me all comes down to expectations of future returns from a company. If you map out a company and you've done the work on it, you're buying it at a current price today, and based on the cash flows, based on the earnings, you believe the company will have a 15% return, it's undervalued because unless other things are going to have a 15% return, unless the stock market is, unless treasuries are, this thing is going to return better, meaning it's undervalued comparatively speaking to everything else. So something, in my opinion, that returns an expected 15% is undervalued. And then something that returns, let's say, 6% or below, something that returns 6% or below, that's overvalued. You're paying too much for it. If you do analysis on a stock and your expectations are that it's going to return 5 to 6%, buy a treasury. Put your money in a savings account. Why take on risk to get something that's going to give you lower returns than the S&P 500? Now, if you buy something and your future expected return is 9 to 10%, I consider this fair value. I don't think it's overvalued. I don't think it's undervalued. I just think it's close to fair value. So when I do my videos where I have the different categories of fair valued range and then undervalued and overvalued, these are the ranges. If it's returning 15% and that's my expectations, I think it's undervalued today. I think it's a really good buy. If it's returning 6%, I think it's overvalued. Like, I'm not buying the asset today. I might hold it, like if I don't want to sell it, but I certainly don't want to buy things that I think will return 6%. And then if my future expectations based on the current price are that it's going to return 9 to 10%, that's fair value. So that's how I look at the question of undervalued, overvalued, fair value. So now that we've gone over my definitions of overvalued, undervalued, and fair valued, I want to take a look at some examples of the specific situations I look for when investing in individual stocks where I think I'm in an overall good situation, an attractive valuation situation. Sounds kind of funny, but valuation is not just numbers on a spreadsheet. When you're buying a company, you're buying an entire situation. You're buying an asset that has employees, that has customers, that has a certain price tag attached to it. And you want all the stars to align. You want things to be going, the way that you want them to go all around. You don't just want some things working out. For example, what I see where a lot of people get in trouble, especially beginner investors, and this is something I would be concerned about, is it's always the case where beginner investors, they focus too much on story and not enough on realistic fundamentals. They focus simply too much on story. For example, a beginner investor might hear a story about disruptive innovation, about how these old fogey companies, they're old, they're getting outdated, and all these newer companies are going to uproot them and disrupt them. That might cause a lot of new investors to invest in Cathie Wood's ARK Innovation ETF. The marketing on her innovation ETF was brilliant. She specifically targeted naive green investors, new ones, with this really hot marketing material. In fact, she released a YouTube video that basically said you're a dummy if you're investing in an ETF. If you're buying the big companies, the Apples, Microsofts, and Googles, why would you buy those when there's all these younger ones that are more magical and they're doing things that are far better, far superior? She made it sound like you were obtuse and old-fashioned if you didn't go with her new fund. Her fund attracted billions of dollars of retail money. So many people on Robinhood, on M1 Finance, on whatever application, investing more and more money into ARK ETF. And of course, it had an epic implosion. It burned $12 billion worth of value for investors. She holds the record for burning more retail investors' money than anyone else in history. And that's because it's scientifically proven. In fact, they've done studies on this, and they found that new investors are attracted to stories of a company. You hear companies that, you just think, wow, like look at this narrative they're painting. They're creating all these satellites. They're doing this technology with AI. They're reinventing, they're making this lab-made food. It's going to take over the world. And they get attached to these stories. And what new investors don't do is they don't dive in to balance sheets. They don't dive in to operating income and margins and long-term trajectories of revenue. They don't dive into things that are the actual fundamentals. Instead, they spend the majority of time on stories. So one thing that I try to do is to never get anchored too much to a story or a narrative. Narratives are the most powerful thing in the universe. There's communications people that will tell you. The person that can change the views of somebody through a narrative, that's the most powerful thing you can do. But in investing, it can be dangerous because you can believe false narratives. You can believe narratives that are not true, that management of a company wants to paint for you, that other investors try to share, that are false stories. They're false narratives. I kind of believed one of them for a time, and I'll share this story. I invested in late 2020 into a company called Peloton, because I saw like everybody in my neighborhood getting a Peloton. They had the delivery vehicle, right? The delivery van dropping off Pelotons. And I was like, wow, this is cool that like everybody's getting in shape. And when you buy the Peloton thing, you have the initial purchase of the Peloton bike, and then you have the subscription for $40 a month after that. And I just saw it blowing up everywhere, on Instagram, on Twitter, online. Everybody had their Peloton. They're showing it off in their rooms and their living room. And I said, you know what, I'm going to go for it. And I put $1,000 into the company. The stock was just nuts. It went up like crazy. It went up like triple. So I had $3,000 in this position. And the story was there. The narrative was amazing. The narrative was that there's this new device that's going to get rid of all workout machines. It's interactive. You have these classes and you're pumped and people are getting in shape and they love it. More and more people are signing up and they have too much demand. They can't even manufacture the bikes fast enough. They're coming hot off the press, right? They're still warm from being made by the time they're delivered. Like that was the narrative. It was great. And I kind of bought into it, right? I bought into it a little bit, and $1,000, so not like a huge position. It went up huge, and then the stock settled, and I thought, wow, this is cool. Like I just got a stock that went up 3 times. Now, over the next 6 months, I started to notice things, and it was kind of like I started to question the narrative. I talked with my brother, he's a surgeon, he's a doctor, and I was talking through him with the investment, and he didn't know anything about it. And he's like, you really think people are going to continue to work out all the time? Right? He's kind of like a jaded doctor. He knows humans don't take care of themselves. Like we don't exercise regularly like we should. And I had a conversation with him where he questioned the longevity of it, the fact of people exercising all the time and still paying that steep membership. And so that kind of put like a bug in my ear about maybe people won't pay for this membership forever. And then over time, I just became convinced that people would not pay for their Pelotons, that people paying a lot of money to work out every single month on a device is not something that's going to stick. Because I remember that even myself trying workout routines, you have the devices here, it's tough to stick with it. You have to have a lot of grit to stick to a workout routine past 3 months. And then I saw some news, the first red flag that Peloton had a change in demand. And that's when I knew that the narrative that I was told was not accurate. The true story of Peloton was a company that had an explosive social media interest one time during a pandemic. And outside of that, demand absolutely imploded. It went through the roof at first and then right through the floor. Because over time, reality started to sink in to me that there's no way they're going to be able to keep this up. Like people are just going to buy more and more Pelotons and pay this monthly subscription forever. It's just never going to happen. It requires too much of people. I'm expecting humans everywhere to pay a bunch of money every month to work out hard on a device every day. That's expecting way too much. So when I was thinking about that, I was thinking, I have to get rid of Peloton. I got to keep my Netflix. Because look at human behavior. Netflix requires people to be lazy and they want to sit back and be entertained. I can expect that out of people. Everybody can do Netflix, right? It doesn't take a lot of you don't have to do anything. You just pay a couple bucks and you're a Netflix subscriber and that entertains you. But Peloton is not entertaining you. It's you doing a lot of work. So once I realized that the narrative that I had kind of bought into was not accurate, it changed my perspective. And then when I looked at the numbers of Peloton, I thought, wow, there's no numbers here to support this stock. The whole thing is built on narrative. It's built on story. That's the valuation in the stock, all of its story. If we look at Peloton, we can see a stock that was built on story. Let's go ahead and take a look here. This is it. Look at that stock price. Now I bought it, I think at like 60 or 70. I can't quite remember, to be honest. But it went up almost 3 times. There it went up to 150. And then it dropped back down. And I sold it at 115. Right in these peaks right there. I got so nervous with it because I no longer believed the story that I had been fed. And then demand soon after just crushed quarter after quarter of like 20, 30% drops. And now it's down 82% from the past 5 years, but it's down like 99% from where I sold it. I sold it at 115 and the stock is currently $4. This is the example of a stock held up by a story. Stories and narratives are okay in investing. Every stock has a story, right? Peter Lynch says that. He says every stock has a story, but you need to make sure that that story is married with fundamentals, with valuation. I would argue that valuing a stock is the marriage between the story that you have in your mind, the narrative for a stock, and the fundamentals. Both of them come together, they form a union, they become one, and that is your valuation when the story meets the fundamentals. So with Peloton, this is a good example of a stock that had a story but had no fundamentals. And those are ones you want to avoid. Because if your whole thesis is built on story, stories and narratives can change on a dime. Stories are based on sentiment. Sentiment can go negative in 1 quarter. You have to have fundamentals to back it up. With every single stock, you have to have fundamentals. And this shows you, again, Qualtrim shows you the fundamentals. Like this stock was losing money, right? It didn't have any fundamentals. So Now, how do we manage to marry the story and the fundamentals? Okay, we'll take a look at an example here. We have one that I recently bought into. This is a company called Salesforce, and it's a large company that does a lot of business-to-business software sales with companies that are looking to manage their employees, they're looking to manage their customers, their sales team, their leads, their marketing, their online commerce. They're looking to manage everything of the company. They are the CRM, the management tool for companies. So I look at Salesforce as kind of like a version of Microsoft. It's kind of like a Microsoft Office where it's just in every company, except it's for managing all different aspects of the company. Now, when I look at Salesforce, let's first go over the story of Salesforce. Because again, I like stories, I like narratives, but I don't like them to be false, and I don't like them to be unmatched with fundamentals. You got to have good stories that are true and are matched to fundamentals. When I look at Salesforce, here's the story behind it. This is a company that's done a lot of great growing organically, and it's done a couple key acquisitions throughout its life that's made it a powerhouse of a company. I truly believe it's just powerful. I've worked with this business before. I've done integrations with it. I've worked with its RESTful API. I've built applications that connect with it. I've worked on the front end and the back end. I've gone into meetings centered around Salesforce. I've talked to their salespeople. So I have some familiarity with it. And Salesforce is a company that basically once your business starts using, they just have more and more tools for you to use. For example, they have the Salesforce Cloud. They call it Sales Cloud. And this is a portion of the business that's like tracking your leads, tracking your customers, all that type of stuff, just basic Sales Cloud stuff. You have the Service Cloud. This is more like customer engagement along the way. They have a lot of tools to do automated messaging, text messages, email messages, getting the right customer service. There's so many other services underneath this. I'm giving this like a 2-second overview. They have Platform, which is tools to help developers create tools on top of Salesforce. So they have like an app store built in, similar to Apple's app store on the iPhone. Salesforce has one for salesforce.com. And developers can build tools that they sell to other businesses to help them with integrations and all sorts of different things. So platforms like the app store version of Salesforce. Then they have marketing and e-commerce. This is a whole section of the company that builds things for marketing. Think Intuit's MailChimp. That tool, Salesforce has similar things, automated email marketing, campaigns for different companies, as well as it has kind of a Shopify competitor, an e-commerce builder where you can build your own e-commerce website on Salesforce's platform. And then you have integration and analytics. They purchased a company called MuleSoft, which I've also read the manual on. I did integrations with MuleSoft, its automation tool and integration tool. And then they have analytics, which they bought a company called Tableau. Tableau is similar to Qualtrim, where it takes data for companies and visualizes it in a helpful way. Point being, when I look at this company, I think, wow, have they constructed a very powerful enterprise of applications to sell to Fortune 500 companies and mom and pop businesses. They own this category. They have a couple competitors, but man, has Salesforce made a robust set of tools here. It's just amazing. The Sales Cloud is growing, and we're going to have Kagers in here soon in Qualtrim. But the Sales Cloud is growing quickly. The Service Cloud is growing quickly. The Platform Cloud is growing quickly. And one thing you'll notice, it went down here. Not to be concerned, they simply just broke out the integration and analytics part of it. So if you had that still in there, steady growth. They just broke that out. But then we get to the marketing and commerce, growing steadily. We get to integration and analytics, growing steadily. I love that every part of this business is growing. So I have a narrative that I've created in my mind that I think is accurate. I think that Salesforce has compiled a list of the best assets and combined it into one company for managing other businesses. I believe that there's going to be long-term secular growth trends where it's the biggest winner takes all. We've seen that in different markets with Microsoft and with so many other companies, and I believe that will happen with Salesforce. So this narrative I'm creating, again, the story is one of secular growth, which means the company is going to grow for a long period of time. It's one of a dominant market position. It's one of an unsaleable moat that no other company can really take or really just knock them out of the way. They're a big challenger. They're not easy to defeat. So I have this narrative, this story I'm creating, but now we got to look at the fundamentals, okay? We've already gone through the revenue, but what we want to do is we want to match this narrative with the fundamentals. Well, when I'm looking at fundamentals that will back up a stock where I don't think I'll lose a lot, I look for a company that has growing amounts of free cash flow every year, and it's a company that I think will continue to grow free cash flow in the future. Now, why is that important? Because it's, in my experience, difficult for companies to lose substantial value while growing free cash flow over a 5-year basis. It can happen. I'm sure there's examples of a company growing in free cash flow and going down in stock price, but it's rare. It's rare. You had to dramatically overpay for that to happen. So in most cases, when a company grows free cash flow on a yearly basis, stock price usually goes up. Just that simple. If you can find a company that grows free cash flow over a long-term basis, 5 to 10 years, more than likely stock price is going to go up unless you dramatically overpay. And we'll explain how to not dramatically overpay. The things that cause the free cash flow to go up are, again, this narrative of long-term secular growth. You want to see all these components of the company growing, and you want to have solid reasoning of why they'll continue to grow. So you need long-term secular growth of the revenue, and then you want a company that has a very strong balance sheet so that it can do buybacks. So if we look at Salesforce, we look at the balance sheet, what do you know? It has twice as much, in fact, 3 times as much cash as it has debt. So super strong, diversified revenue stream, highly concentrated industry that it owns the majority market share in, growing free cash flow year over year. It's doing great on these parts. And then we have a strong balance sheet, way more cash than debt. So far, signs are pointing in a positive direction. The next thing I look for to cover my downside, again, is a company that can do a lot of buybacks. Now, Salesforce has just turned the corner on this. For a long time, they were issuing shares, paying developers that way, but notice how it flattened out and it started going down. They bought back only 0.5% worth of shares year over year, but it is going down from 1 billion to 980 million. So they bought back 17 million shares. Why are buybacks important as part of valuation? Well, again, I look at not just the valuation, I look at the whole situation of a stock. I'm looking for an attractive valuation situation where everything feels good to me. Of the whole stock, everything well-rounded. So it's a little bit more holistic than just looking at numbers on a spreadsheet and the stock is, cheap on some metric. When I look at Salesforce, the reason that I think that I have an attractive situation is because they have a lot of money to be able to put into buybacks. Meaning that if the stock goes down, okay, let's pretend it goes down here, like 20% or even more. What if it goes down 50%, right? What if the stock gets cut in half? Bummer, right? That's no fun. But if it did, they could buy back shares at double the rate. The money that they can now put into buybacks because they're earning a lot of free cash flow are double as effective if the stock price goes down by half. Because again, if they do buybacks, they're buying their own shares. If the share price goes down by 50%, now they can buy back their shares at a cheaper price. When they reduce the shares outstanding at an accelerated rate, that means it increases the rate of growth of the free cash flow per share and the earnings per share. When you increase the rate of growth of the free cash flow per share and the earnings per share, it makes the stock more attractive, relatively speaking. It makes it growing faster. And that can protect the downside. It's very similar to what Apple's doing, right? Apple went through a dip, right? They're going through a dip right now, a small one. But if we look year to date, it went from 195 down to 170. And then Apple's like, hey, we're just going to buy back $110 billion worth of shares. Well, think about that. If they're using that money to buy back the stock, the cheaper the stock is, the more effective these buybacks are. And the faster their earnings per share grow, the faster their free cash flow per share grows. So a company that can do a lot of buybacks, it's actually advantageous if it has a cheaper stock price because they can do it so much more effectively. So in order to protect the downside, I look for companies that have a great story, a wonderful story. I want stocks that have long-term secular growth trends. I want them to have these business segments that are all very powerful, very dominant. They're unassailable, very difficult to compete with and to replicate. I want businesses that have healthy balance sheets, so they're not weighed down by a lot of debt. That's never a fun situation to be in. It really weighs down companies and slows down their ability. I want companies that can do buybacks, and they can do it especially if the stock price falls. So if Salesforce falls 50%, I just kick my feet back and I go, you know what? I don't care. They're just going to buy back 1 million shares every single month, 1 million every 2 weeks, 1 million every week if it gets cheap enough until the stock goes back up. And because I know they can just continually pull that buyback lever and pull it, and they can make the earnings per share grow faster, the free cash flow per share move up faster, because they have that ability, I know it's a matter of time until the stock goes back up. Gives me confidence to hold on to it in a downturn. And that's another important aspect. So that's a few things I look for to get into a situation of valuation I think is attractive. I want a great story, but again, stories without fundamentals, you're just up here in a cloud. Nothing is supporting your stock. And if the story changes, you're done. That's what happened to Peloton. Great story. Turned out the story was false. And once investors realized that, there was zero fundamentals to back it up. So the stock's done, lose 97%. So I want a great story, but then I want to marry that with great fundamentals. Diversified revenue, growing, dominant market position, long-term secular trends, very strong balance sheet, ample room to do buybacks if the stock dips. And I think when you get those two things, the story plus all of that stock, or all of that stuff, I think you're finding a pretty good situation. Now, of course, again, we haven't talked about price, because even if you have a great story and you have great fundamentals, you found a good situation with the stock, but you still want to get it at a decent price. And that's where we get in to pricing it out of when to actually pull the trigger and buy this thing. When we look at this, I look at it and I go, you know what? Again, we go back to the risk-free rate. Let me go back to this. Every stock, you're valuing it based on opportunity cost, and we know the risk-free rate is 5%. So if I look at this, I look at Salesforce here, and I know that treasuries right now are 5%. Well, Salesforce right now has a free cash flow yield of 3.5%. With stock-based comp, it's more like 2.5%. So it's about half of what the risk-free treasury is. But 2.5% to 3.5% based on stock-based comp, this isn't a bad range when you're looking at a company that I think is as high quality as Salesforce. Now, the way that this works is this is the amount of money you get paid to you in cash per year when you buy this stock. Meaning that if you paid $100 and you bought $100 worth of Salesforce, if it has a 3.5% free cash flow yield, that means every year the company generates this much money that they can return back to you, the shareholder, in the form of buybacks and dividends. So at just a quick glance, the higher the yield, the cheaper the company's selling for. But again, we don't want to confuse cheapness and expensiveness with expected returns, because a lot of times really cheap companies, Delta Airlines, right? We have these really poor businesses, they'll have higher free cash flow yields because their cash flow is not dependable and it's not growing. But Salesforce is a company that has a pretty okay free cash flow yield, not like ideal. I'd love it to be above 4%, but it's okay. And it's wrapped up in a phenomenal business. Again, you're getting this yield plus all this stuff, plus the growing revenue, plus the free cash flow, plus the buybacks, plus the strong balance sheet. You have to factor in the whole situation, not just these quick metrics. Most investors that I see, they just look at a few metrics. They go, oh, the P ratio, oh, the free cash flow yield. I'm done. I don't even want to look at it. That doesn't give you enough context to make an informed decision on whether or not the expected return is high or low. So basically, I want to find a company that has the attributes that Salesforce does and the kind of situation it does, but I want to find it as cheap as possible. I want to find it in a big dip. I want to find it that it's sold off for some reason. I bought a little bit more Salesforce because this year, the company sold off around 8%. It went from 301 to 270 because of a rumor that they were buying another company. That's a non-fundamental thing. They didn't buy the other company. It was just a rumor, and it was down 8%. So I thought I'm going to buy a little bit more because I've already done the research. I like the company, and it's 8% cheaper. So there are situations where you can buy like that. Another thing that I look for when I've identified a good company is the moving averages and kind of like what companies are going through a dip. So I can look at this stuff as well. I can see all my holdings. I can see the 200-day moving average, the 100-day. I can look over the past 6 months and see what's done really well and what hasn't, right? That can lead me to a different company. But again, we want to go back to what is the right price to pay for this. Again, everything I do is based on future expected returns. And let me show you what my future expected returns are with Salesforce based on today's valuation, today's market price for it. We go to the scenarios tool on Qualtrim. If you haven't used this, this is one of the pages on Qualtrim, and you can create scenarios for any stock you want. So we have Intuit here. Let's pull up Salesforce. I have a bunch of them here. You can see I run scenarios on all these different stocks. We have Salesforce here, and I have one scenario called base scenarios. You can create multiple for the same stock. Let's go ahead and take a look at a few of my assumptions. Right here, I have assumptions in the stock of what I think will happen. I think that Salesforce is likely to grow its revenue at or above 10%. So I put in 10% annual compounded revenue growth, and I'm expecting that for the next 10 years. Okay, so 10% revenue growth. The percentage of EBITDA to revenue, this is the margins for the company. It already plugs in that the company had around, I think it was like 35% margins. It'll tell you what it currently is, and then you can gauge how far you want those to move up, how far you think they'll move up. Salesforce is currently in a stage in life where it's improving the margins every single year. So I assume the margins will continue to improve. I think the margins will go from 34 to 43%. So they're currently at 34%. I think they'll improve to 43% over the next 5 years. Then we have capital efficiency. What percentage of revenue does this company spend on CapEx? Well, they have been spending around 2%, and I predict they'll continue to spend around 2%. So I leave that unchanged. I think as a percentage of the company's revenue, they'll spend 2% on it on CapEx. It's not a CapEx heavy company. And then in terms of predictability, how is this company valued with its predictability? Highly predictable companies, like Costco's are high. Low predictable companies like oil companies are low. I put Salesforce as a medium. And this just kind of helps you determine what an appropriate multiple is for the company. And then there you go. I name this scenario, I give it my starting year, and I put in the current market cap. And then boom, I have Qualtrim here. It calculates exactly what this company is going to produce in cash flows. This is a 5-year projected financial for the company. So when I look at this, I look at the revenue growth. We have 10% revenue growth. I'm assuming it's going to stay around that for the next 5 years, which I think it can actually exceed. So I'm being a little bit conservative here. But then based on the revenue and the revenue growth over time, the EBITDA margin calculates how much EBITDA the company will make. And then I factor in the CapEx, which we plugged in was 2%. And then it automatically throws in taxes of what they've paid for the last couple of years. You can adjust this around, but I don't like to play with taxes too much. It changes it a little bit. So if you assume higher taxes, it goes up. Lower taxes, it goes down. And then you have the very bottom here, the cash flow, which is the free cash flow the company will generate. I'm assuming that next year, Salesforce will do $12 billion in free cash flow. Now, if we look at this, I can go to annual here. And this year, Salesforce did 9.5. So I'm thinking that goes up to 12 billion, like right there. I think they'll be able to do that based on these different metrics. Now, if I go back to this, it goes up a little bit every year as the revenue grows and the margins stay, the margins climb and the revenue grows. The two things that are the biggest drivers of intrinsic value with Salesforce is a long-term fundamental story of moderate revenue growth and margins going up. With margins going up a little bit while growing revenue, you have a lot of profit that gets created in between. And this is the profit we're seeing. $12 billion, 13.9, 16 billion, 18.5, and then 21 billion. That's my estimate in 2029, is that they'll produce $21.36 billion in free cash flow. Now, are they really going to produce that? No, it's going to be off to some degree. It'll be a little higher, a little low. But the idea here is to give you a check that if you're even close, is this company even close? So what I do is I create this analysis. It shows me exactly how much I'm expecting the company to grow based on my assumptions. And I have $21 billion. Now, again, if you have a company that's producing $21 billion of cash and it has a free cash flow yield of like 3%, that equates to a valuation. If you have a company that is producing $50 billion of cash and it has a yield of 5%, you have to tie these two together. And that's exactly what this next part does. What this next part does, which is the return profile, is it ties these two things together. Your yield that you're expecting it to trade at, so the multiple, as well as the cash flow you think it will produce, and the gains between now and the end of 5 years. And that's where you get the rate of return. Like I said, all of my valuations are based on rate of returns. If Salesforce produces $21.36 billion in free cash flow in 2029, and it trades at a 3% yield, 3% free cash flow yield, that'll be a 19.5% return. It's pretty good. It's a 20% return. Now, let's say investors, they don't want to pay quite as much for it. When they don't buy it, right? If investors don't buy something and they're selling it, the yield on that thing goes up because the market cap's going down, which makes the yield go up. So the yield right here is inversely correlated with a multiple, meaning that if you're paying 1% yield on something, you're paying a 100 times multiple on it. If you're paying a 2% yield on something, you're paying a 50 times multiple. So the higher the yield goes, that means that the thing that you're buying is cheaper and cheaper based on the multiple and the yield. So a lot of people get confused. They're wondering why the returns go down when the yield goes up. Well, if something's trading at a 7.5% yield, that means that people sold out of it. The multiple has gone in half. It went from like what does it trade at right now? Like a 35 multiple down to like a 12 multiple, right? So the multiple's gone down like crazy if the yield goes up. So I don't want people to get confused. Another way of thinking about this very simply is if it trades at 3% today, let's say the free cash flow yields 3% today, this shows you the return if it were to just stay at 3%. So right now, Salesforce trades at 3.5%. The return, if it stays at the exact same yield, if the multiple or the free cash flow yield doesn't go up or down, it's going to have a 15.8% return. And that's kind of what I expect. I expect Salesforce will trade somewhere around, a 3.2% yield to a 3.7, somewhere in that vicinity for the next 5 years. And if it does, based on this amount of cash flow, the company will have around a 15% return. So that is what I'm assuming with the stock. Now, again, if you plug in numbers here, you want to be realistic with them. The more realistic you are with the numbers, the better your analysis is going to be. So you don't want to try to trick the computer and put in huge numbers. It's going to give you a huge outcome. Your goal here is to have an accurate representation of the different possibilities, and you want to protect the downside. For example, if there's bad news for Salesforce, right? Like if another, Google starts competing with them or something, then there's going to be a multiple decline, which means the yield will go up and the stock price will fall. And I look at different scenarios there. Even if it went up to a 4.5% yield, I still earn 10% per year. Even if it went to a 5% free cash flow yield, I still earn 8%. Not bad. Now, if it goes all the way to a 6%, I'm still in the green. I'm still making money. At least I'm not losing money. And that means that the stock, the free cash flow multiple is going down and the yield's going up, meaning people are selling out of the stock. So I have a good degree of downside protection here. We have to get above a 7.5% yield or above a 7% yield for it to finally go negative on an annualized basis. And then I also don't think it's going to be priced at a 1% yield. That would be like NVIDIA or something growing like crazy. So I think that's out of the cards. It's not going to get priced at a 1 to 2%. I think it'll be between a 3 and a 5%. So I'm expecting returns of anywhere from like 20% to 10%. But again, that's the range I'm looking for. 10 to 20% returns annualized beats the market. So that's a specific example of all the different things I look for each stock. Now, a lot of this takes some practice, right? Because again, I think the thing people want to do when they get into investing is they want to go, oh, it's that is a 30 PE, that's too expensive, or that's this yield, that's too expensive. Okay, it might be, but you want to match that with the fundamentals. You want to look at the whole story. Valuation, in my opinion, is that nice marriage between a true narrative, one where you got the narrative right, and you marry that to really good fundamentals that support that narrative. It's not just buying stocks because they have a great story and ignoring all the fundamentals, ignoring the margins, ignoring the profitability, ignoring the balance sheet. That'll get you in a lot of trouble because narratives do shift. Fundamentals can hang on and stick around longer. But you want to marry a good narrative, a true one, to the fundamentals, and then you want to plug in your assumptions based on that and make sure you're paying a price that makes sense, that's reasonable. Because if you buy really good companies, ones that are powerful, that have cash flows and unassailable market positions, and they have lots of secular growth, you can have a little flexibility in buying them not at the perfect time. You don't have to time it perfectly, but you got to get a price that at least makes sense, a sensible price. If you're buying companies that are just super cheap by the metrics, there's ones that are cheaper by the metrics. You can buy Ford, has a huge free cash flow yield, has a super low PE ratio. You want to be careful and you want to marry this again. You want to look at the story. What is Ford's story? Where's their growth path in the future? What do their fundamentals look like? What does Ford's balance sheet look like? They have way more debt than cash. They have unreliable cash flows. It doesn't grow over time. They can't do buybacks. They can't afford to do it. So the shares just stay flat all the time. If the stock price tanks, they can't employ buybacks to bring it back up. So again, just looking at what's cheap often leads to inferior situations where you don't have an attractive valuation situation. I look at valuation holistically and the whole thing. So that's kind of my thoughts for it. Let me see if I think I covered everything there that I wanted to. You're going to see me buy companies and they'll typically be similar. There'll be companies that are super strong, super profitable. They have long-term secular trends. They can employ buybacks at will. They have what I consider to be unassailable moats. And they're companies that when I plug them into a DCF tool like Qualtrics scenarios, and I run some basic scenarios with very reasonable assumptions, I get attractive returns in most situations. Not every, anything can happen. Anything can happen with any stock. So there is scenarios where things turn out bad for Salesforce. That could happen. But if you have a diversified portfolio, if I have 10 to 12 stocks and all of them are of this attractive of a situation and each individually face different risks, odds are most of them are going to do good. There'll be like maybe one that does poorly, but most of them are going to do well. So even though if I lose money on one, I make money on 11 others and I make a lot more money than what I lose. And that's what we're looking for is I want to win on every single stock I buy. So I'm very, very particular about the stocks I buy. But I do acknowledge that there's going to be situations that play out where the scenarios that are most likely do not occur and something crazy happens with the stock. And the chances, the goal is to minimize those crazy situations from happening. So for new investors especially, and I want to reemphasize this point, for new investors, the biggest risk by far is getting into the channels in the feeds where people just talk about narrative. And they talk about, oh man, like things are going this direction with society. And this is going to be the next big product. And they never bring up a chart. They never do a DCF. They never explain it. And they never make reasonable assumptions. They're blinded by narrative and stories which can change. So if you're a new investor, be aware of that. Do not just believe stories and narratives. Make sure you have a good story for a stock and it's matched closely with the fundamentals, which I've highlighted here. So that's all with the valuation. If you have any questions, you can send them to me, any feedback on this, and I'll see you in part 4.